Hello my fellow investors and welcome back to another stock analysis video. Today guys, let's cover another one of your recommendations in the form of Antero resources, and this one was brought up by Michael F. and he recommended the company AR, which is again Antero resources. So let's take a look at this company, take a look at their fundamentals, also do a quick overview on their earnings, not really go over them, but just like the earnings summary in Seeking Alpha, and then let's see if the current share price, this is looking like a buy. So with that said, let's get started with this analysis. So the first thing that I want to take a look at, guys, is what does this company do? Well, here we have the company profile. Antero Resources Corporation, an independent oil and natural gas company, engages in the development, production, and exploration and acquisition of natural gas liquids, and oil properties in the United States. Interesting. So obviously they are in the energy sector, and since they are in the natural gas and oil related kind of industry, understand that, and crude oil is down on the 1 year 28.5%, and year to date it is down 9.3%. Now crude oil has had a very interesting rise to, I believe, a high of like what, 120, 125 or something like that per barrel, and now it's come down a significant amount. But we can see that again, when it comes to these kinds of companies, guys, they will tend to follow their respective markets. So just understand that when analyzing any kind of commodity company. Looking now into their earnings, we can see that they had this on the 15th of February. EPS normalized actual came in at $1.04, beat by 14 cents. EPS GAAP actual came in at $2.31, beat by $1.43. Revenue $2.09 billion, which is beat by $558.61 million. So let's come into the calculator. We got the ticker symbol for AR, market cap of $6.7 billion and a PE of 3.91. So with a current share price of $22.57, this might be very, very interesting of a buy. And looking at the 1 year graph, guys, they're actually down 27% year to date. They're down again a little bit less than 20.6%. 52-week range is $20.65 to $48.80. So this is an officially 52-week low company. You know, I'd love to see them at 52-week low companies because they actually might serve as a pretty good investment usually. You know, at least when it comes to a price valuation perspective, not so much from a fundamental perspective, from just price alone. Now, they do not pay out a dividend, which is again very, very surprising, but they are a pretty small company to begin with. This means that all of their free cash flow is going straight into themselves. And if you guys take a look at this free cash flow, 493 for the average and $2.11 billion for the last year's free cash flow. That is a massive jump, and I'm already getting scared because, well, you guys know I don't like massive spikes when it comes to anything, because that usually means outliers, and that usually means that they will not be able to sustain it in the future. So jumping now into the fundamentals, we got the net income of negative $397.5 million to today of $2 billion. That is an increase of 578%. And we can see that from 5 to 2 years ago, all in the negatives. 3 years ago was the worst negative because, you know, COVID related, but we can pretty much ignore this. Nonetheless though, that's still a massive spike, guys, from 186.9 2 years ago to 2 billion 1 year ago. I'm sorry, but that is a massive spike. If this was closer to like maybe, you know, zero, or maybe like negative $50 million, or even like $50 million, like in the positive, I'd be like, okay, that's reasonable. But that's a massive spike. I'm gonna give this like a 5%. I'm gonna give this actually a 10% because I just don't know where this might be heading. But we can see that the general trend line from 5 to 2 years ago, it is going up. So I'm going to give them 10%, but that's still not good at all. Looking now at the free cash flow, we see something similar. From 5 years ago, we had negative 128.6 to 1 year ago of $2.11 billion, increase of 1,739% with an average of $493.1 million. Now, here we see that from 5 to 3 years ago in negatives. Actually, they went further in the negative 4 years ago, going from 128.6 to negative 318.7. So yeah, I don't know what caused that. And then from 4 to 3 years ago, they went up slightly, but it was still lower than 5 years ago by around $10 million. Now, from 3 years ago to 2 years ago, massive spike, going from 138 to 944, so almost $1 billion in the positive. And then from 2 years ago to 1 year ago, 944 to 2.11 billion, guys. That's a massive, massive spike. Nonetheless, though, seeing that they did do 2 positive years, I'm gonna give this a 40%. Coming now into the revenue, 5 years ago of 4.13 billion to 1 year ago of 8.72 billion, increase of 111%. We can see a consistent decrease from 5 to 3 years ago. 3 years ago, again, COVID related, so we can pretty much ignore it. But nonetheless, though, why did they come down 5 to 4 years ago? Definitely please do more research on this. And we can see that after the 3 year ago mark, guys, they went from 3.4 billion to 6.5 billion and then again to 8.7 billion. I'm going to give this a 45%. Mainly because, well, I mean, they were able to do it again 1 year ago, like that massive spike from 6.5 to 8.7. So they might continue it, but as I just do not know for sure. So I'm going to give this a 45%. Looking now at the assets minus the liabilities, we can see that this is consistently decreasing, unfortunately. No negatives though, which is really, really good to see. However, we can see that they pretty much went even lower 3 to 2 years ago. I mean, I understand 3 years ago as to why they went as to why they went a little bit lower, but 2 years ago we've seen everything 2 years ago spiking. So this went down a little bit, not by a lot, but just a little bit, and then they brought it back up 1 year ago. Average total assets, it is 14.1 billion. Average liabilities is 7.5 billion. Doing this difference, we get 6.6 billion. I'm giving this, guys, a 65%. At least they have no negatives on here. Cash flow minus the liabilities, though, this one is looking incredible because, guys, they've only had 1 year where they increased it to a more negative, to a further negative, I mean. From negative 7.16 billion to negative 8.54 billion from 5 to 4 years ago. And ever since 4 years ago, take a look at this. Very, very consistently increasing this closer and closer to zero. And on top of that, take a look at this. 1 year ago, it is almost negative $5 billion, which is a lot less, guys, than the average of negative $7 billion. So I'm actually going to give this a 90%. Really, really good. Now looking at the shares outstanding, this one is kind of 50-50. 5 years ago of 308.6 million shares to today of 297.4 million shares. Decrease of 3.63%. And from the previous year to the current year, this is down 5.26%. So this is actually looking really, really good just from these two perspectives. However, we can see that from 5 to 3 years ago, consistently decreasing, shot it up from 3 to 2 years ago, but then brought it back down. So I'm going to give this a 70%. And lastly, when it comes to the cash and equivalents, unfortunately, Seeking Alpha didn't have this, so I put 0. So there it is. They have 0 cash and equivalents. I don't know where to find this specifically. So now looking at the overall grades, we gave the net income a 10%, free cash flow 40%, revenue 45%, assets minus liabilities 65%, cash flow minus liabilities 90%, and the shares outstanding of 70%. Overall grade of 47. The biggest issue that I have here, guys, is this net income as well as the free cash flow. Mainly because of the spikes. That's really about it. So 47%. Maybe if you guys understand why the spikes happen, then maybe this will be a lot higher. But for me, it is 47%. So now let's actually come into the discounted free cash flow to see what price we should buy this company at. Now, unfortunately, this company is making absolutely no sense. Mainly because of the massive spikes that we have seen. And we can see this right here. Guys, with nothing inputted for the revenue and projected share buyback, this is a target share price of $220.65. The current share price is $22.57. So I am not sure that this is correct. Mainly because, again, this kind of free cash flow does not work that well with the spikes that we have seen, for example, in regards to the net income and that of the free cash flow. More of the net income than anything, but the free cash flow still has a massive spikes overall. So this kind of free cash flow does not work for this one. But we can still use the book value per share and see if maybe we can take a look at what the book value should be for this company. And doing this, guys, we can see that, well, the company should be worth right now, based from a book value per share perspective, $22.72. And taking a look at the tangible book value, we can see that it's worth $22.72 once again. So based off of the price and the current book value and current tangible book value ratios, we can see that the ratio right now, guys, is 0.99. Again, 1, it is considered at value, above 1 is overvalued, under 1 is undervalued. This company is pretty much at value. So from what it's looking like from a book value perspective, this is looking like a not bad of a buy. Obviously, this is not financial advice. Please do your own due diligence, because even though book value is telling me that it is a good buy, I still think the fundamentals are pretty lackluster in my personal opinion, especially for an oil company and an energy company in general. So again, please do your own due diligence. This is not financial advice. Every investment is the present value of all future cash flow. This is why I give out all of these calculators for free, guys. This one, the discounted free cash flow, the revaluation, and dividend tracking sheet. Even though this company does not pay the dividend, please have them for free, because again, I don't know what you guys like. I don't know what your financial situation is. I don't know if you guys, may like, I don't know what your grade for this company may be. So if you guys have these calculators, you guys can put your own grades and see where you land. And then if you think, no, but this, no, but that, then you do your own due diligence. Again, this video, this content that I make is not due diligence, okay? Due diligence is reading the company's 10Ks, reading the company's earnings report through and through, and all of that stuff, right? This is not a due diligence kind of video. This is not due diligence kind of content, because if I were to do all of that for every recommendation that you guys give me, I would probably have not been through maybe Roberto CJ's HLI company back that I did on January 8th. So again, there's no way that I could do a due diligence for all of your guys' companies. So please just keep that in mind, and hopefully you'll understand. So again, please have all these calculators for free. All I'm asking for in return, guys, is just like, subscribe, comment. Really does help with the algorithm on YouTube. We're almost up to 2,300 subscribers. Dear Lord, y'all are crazy. So thank you so much. Hopefully everybody's enjoying fundamental analysis and technical analysis, the occasional wealth videos, and the occasional, I guess you could say, podcast that Mike and I do together. But yeah, hopefully everybody likes it. And again, the best way that you guys can help us is just like, subscribe, comment, and of course, share. And now taking a look at the options chains for AR, we can see that this actually has weekly options, which is honestly kind of surprising. I was not expecting that. And we're looking at the March 31st options chains, guys, for the puts. We can see that there is a little bit of liquidity. Actually, there's a decent amount of liquidity going all the way down to around $20 strike for the puts. And in regards to the calls, we can see that it goes pretty much up to $25.50 roughly, right? There's still volume up here, all the way up here, all the way up to $26.50. But still, though, the most of the volume is situated between $23 and $24. And for the puts, it's mainly for around from $22.50 to around $20. So yeah, the option chains is looking okay, I guess you could say. Not really anything of super high puts, but then again, the March 31st one is almost, the expiration date's almost here. These contracts are losing value through theta decay, so not surprising. Looking at the April 6th, though, we can see that there's a little bit more premiums here, from $26 at $21.50 strike to $61 for the $22.50 strike. And for the calls, it is $45 for the 23 strike, and let's just say $6 for the 25 strike. All in all, thank you so much for the recommendation. I do love my oil companies. I really, really do. However, this one, it has potential, don't get me wrong, but I just need to be more sure as to what the direction of the cash flow and the net income is going to be. If I don't see that much direction, if I see it's just for example, if this year we go down from what we did last year, that's going to be a red flag for me. I'm going to be like, yeah, I'll probably put it a lot lower. But for now, it's mainly not so much that it's bad. It's just very, very weary of what direction is going to go. That pretty much does it for this video, buddy. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link in the description below. So with that said, peace out. And we'll see you all in the next stock analysis video.